To Alan Greenspan's credit, he came in August of 1987, and he'd had a series of conversations with Jerry Corrigan, who was the president of the New York Fed before that. But Greenspan saw that one of the things he hadn't done before was manage a crisis, know what to do, and there were all kinds of contingencies he was worried about. So in the couple months after he got there, he tasked the staff working with the New York Fed to put together a book of various alternative problems and crises that might arise. One of those crises was a stock market crash. I think there was a run on S&Ls and some other things in there also, but I thought it was a good exercise for everybody to go through, and as I say, a tribute to Alan Greenspan that he saw preparation for something like this was good. Let's dial back just a couple of days. So the previous Friday, equity prices had dropped quite substantially, I think about 5% on the S&P. So it was a pretty, and that culminated, that was at the end of a run of other declines in equity prices. In addition, Jim Baker had given some speeches in which markets were interpreting the thing as there being tension between the U.S. and some of its allies with regard to the value of the dollar, what were happening to interest rates, just in general. So you started with a day of declining stock prices on Friday in very heavy volume. You had a lot of nervousness and conversation over the weekend. The newspapers featured this Baker interview and what it might do to stock prices. And then as U.S. markets opened, they opened down, and then things began to slide away from there. But at some point before long in the day, there was a sort of a contingency group planned, contingency group assembled in what you and I know, David, as the special library, the board members' library. And there, everybody brought their books with contingency plans. I don't actually remember opening that book, but I remember I had it with me. And people started talking about what might happen and what the Fed should do. Greenspan, there was a discussion, should he go to Dallas, shouldn't he go to Dallas? In the end, the decision was that if he didn't go, it would send a signal that he was very, very worried and might even unsettle markets by even more. So there was this group headed by Manley Johnson, who was the vice chair when Alan Greenspan left and got on the plane. And we were looking at various contingencies and what to do and keeping track of the equity market. So that was the kind of the scene that day as markets dropped substantially. I think when I went home rather late-ish that night, but was later than usual, but not out. It wasn't midnight or something. Nothing had been decided, and there was discussion about issuing a statement. As I read other things, and then by the next morning, early the next morning, in consultation with Jerry Corrigan in New York and Alan Greenspan down there in Dallas, the statement had been issued. I do not remember being in the conference call at which the statement was fine-tuned. So I've read these memoirs in which it says Mike Bradfield, who was the general counsel of the Federal Reserve Board, came with a statement that was very legalistic, was long, it referenced the Federal Reserve Act, etc. And then Corrigan apparently said, no, we need to be simple, to the point. We need to make it clear that we recognize our responsibility is to make sure that the system is liquid and supply the liquidity, any extra liquidity that might need under these unusual circumstances. So that was the statement that was issued first thing the next morning. Well, I think my first piece of advice would be try to prevent them as best you can. Make sure the system is resilient. This is something that's happened to a considerable extent after Dodd-Frank with the banking system and with the reforms were put in place really all over the world after the 2008 crisis, the stress tests on banks, et cetera. So I think thinking back to 1987, the banks needed to be able to advance those funds. They needed to have enough capital that when they advanced those funds, people would still be advancing funds to them. So the banks were resilient, and it's so important to keep the banks resilient. But I think the real challenge for policymakers now, the ex-ante challenge before the crisis, trying to prevent crises, is to build the resiliency of the non-bank financial system, which is much more important than it was in 1987. And that's hard because of the way regulation and supervision of that system is scattered throughout agencies of the U.S. government, the CFTC, the SEC, et cetera. It's hard because it's hard to run a stress test on some of these systems, these really market-based systems. It's hard to know what they're, but I think that's, and a lot of the action that has followed March of 2020 has focused on the non-bank system, because that's the non-bank financial system is what really froze up in March of 2020. So I think that brings that underlines that point. Now, what to do in a crisis? I think we did the right thing in '87. I think we did the right thing in 2007 and 2008. You just pour liquidity into the system, and the J. Powell Fed did the right thing in March of 2020. You just make sure that these extra demands for liquidity, what people called in March of 2020 a dash for cash, that they could be satisfied, because if they're not, then the system will indeed freeze up. So I think supplying liquidity quickly in a crisis is the right thing to do. I do think there are moral hazard issues here. I worry about them, but I think when the system is in the process of freezing up, the damage to the economy could be so vast, and so many innocent bystanders, people just going to work and having jobs and buying and selling, people who own businesses, people working, could be hurt, that it's up to the central bank, the Federal Reserve, to make sure those markets, to supply the liquidity necessary to make those markets work, and then work after the fact, as we are doing post-March 2020, to figure out what went wrong, how can we fix it. So I think the cure for the moral hazard of this intervention is imposing requirements and regulations on pieces of the system that broke down in that time, or and make sure see how those systems can be made to work more smoothly and have a capacity to deal with the stress, and that's what people are working on right now.